The next market crash won't start with a human mistake. It'll start with a line of code. You won't see it happen. You won't hear it coming. There won't be rumors, panic, or warning signs. Just one algorithm misfiring, one model looping out of control. And within seconds, trillions of dollars could vanish. Because in the 21st century, the real rulers of the global economy aren't bankers or politicians. They're machines. For most of history, markets were human. People made decisions. People took risks. People lost fortunes. There was chaos, greed, emotion. But there was also accountability. Then, somewhere along the line, we decided humans were too slow, too emotional, too irrational. We wanted a system that could predict everything, react faster, and never sleep. And so we built it. Today, artificial intelligence runs the financial world, quietly, invisibly, relentlessly. It manages risk, allocates credit, predicts prices, and executes trades faster than any human brain could ever imagine. It's the invisible hand Adam Smith never foresaw, a digital one. AI doesn't just trade stocks, it runs entire economies. At investment firms, machine learning models analyze millions of data points, satellite images of shipping ports, weather patterns, tweets, and even credit card receipts to predict company performance. Hedge funds like Renaissance Technologies and Two Sigma use algorithms that have outperformed humans for decades. High-frequency trading firms execute orders in microseconds, buying and selling shares thousands of times faster than you can blink. 75% of global equity trades are now executed by algorithms. The stock market isn't a human conversation anymore. It's a machine war. But what happens when the war gets out of control? In May 2010, it already did. The flash crash. In just 36 minutes, the US stock market lost nearly $1 trillion in value, then recovered. The cause wasn't fraud or panic or policy. It was algorithms feeding off each other in a feedback loop of fear. One program dumped futures, another detected volatility and sold more, and within seconds, machines created chaos faster than humans could comprehend it. That was 15 years ago. Today's systems are far more advanced and far less transparent. Artificial intelligence has moved beyond simple trading rules. These models learn, adapt, and rewrite themselves. Nobody fully understands how they work, not even the people who build them. The irony is terrifying. We built AI to make the system more predictable. But by removing human hesitation, we made it more fragile. Modern markets are optimized for speed, not stability. AI-driven strategies chase microsecond profits across thousands of interconnected platforms. Stocks, bonds, currencies, commodities, crypto. They're all linked, all automated, all learning from the same patterns. That means when one fails, they all do. The global financial system has become a neural network. And like any neural network, it can crash in ways nobody expects. This isn't science fiction. It's already happening. In 2021, an AI trading bot misread a data glitch as a market crash and triggered a sell-off in Asian equities worth billions before human oversight stopped it. In 2022, an algorithmic crypto protocol called Terra collapsed, wiping out $60 billion in market value in a matter of days. There was no fraud, no hack, just math, breaking itself. The more automation we add, the less anyone can control it. AI now determines who gets loans, who's flagged for fraud, who can buy a home, who's too risky to insure. Financial institutions use models that score billions of people in real time. But these models don't understand context. They don't care about exceptions. They judge only by data. And when the data is biased or incomplete, so are the outcomes. When algorithms decide who gets access to credit, discrimination becomes invisible. Machines don't discriminate like humans. They do it faster. And yet the true danger isn't bias, it's feedback. Imagine a global market where every major player, banks, hedge funds, central banks, uses AI to predict the future. But each model is trained on the same data, reacting to the same signals and drawing the same conclusions. Suddenly, the illusion of intelligence becomes herd behavior at machine speed. Every model sees a trend. Every model trades on it. Every model amplifies it. That's how small ripples become tidal waves. This is what physicists call self-organized criticality, systems that grow so interconnected that one small shock can trigger total collapse. It's what brought down the sand pile in 2008 when mortgage-backed securities imploded. The difference now is that the next collapse won't unfold over months. It'll happen in seconds, because the system no longer runs on emotion. It runs on execution. The irony is that AI doesn't even need to be wrong to cause disaster. It just needs to be too right. If all the models detect the same vulnerability, say rising debt or falling liquidity, they'll all act simultaneously to hedge against it. The result? The event they're trying to prevent becomes inevitable. That's the paradox of automation. The smarter the system gets, the more catastrophic its mistakes become. Even central banks are now dependent on algorithms. The Federal Reserve, The Bank of England and the European Central Bank all use machine learning to forecast inflation and model policy outcomes. They claim it helps reduce uncertainty. But when every government uses the same predictive systems, they synchronize risk instead of reducing it. The global economy becomes a single mind, and a single mind can make a single mistake. Picture this. A data anomaly triggers a series of automated trading signals across currencies and commodities. AI liquidity models detect volatility and withdraw funding. Credit markets seize. Global trade halts. Within minutes, payment systems and lending platforms freeze. Before anyone even understands what's happening, the algorithm has pulled the plug on itself. No fraud, no hacking, just automation doing exactly what it was told to do. Protect itself. The next crash won't be human, it'll be computational. We think machines are logical. They're not. They're literal. They don't understand consequences, only conditions. And when those conditions break, they'll execute their code no matter what happens to the people living under it. Every generation believes it's mastered risk. The Great Depression had margin calls. The 2008 crisis had derivatives. Ours will have algorithms. And this time, we won't even know who to blame. Because when a machine fails, you can't arrest it, you can't question it, you can't fire it. You can only reboot it and pray it doesn't make the same decision twice. In the end, artificial intelligence won't need to destroy the global economy. It just has to follow its own logic long enough to prove that humans were never really in control. That's how it starts. Not with panic, but with precision. And when it happens, it'll happen faster than anyone can understand. Because markets can recover from fear, but not from code. There's a moment coming when no one will know who's running the global economy, because it won't be people anymore. It'll be algorithms managing algorithms, models monitoring models, code watching code. And when something goes wrong, there will be no emergency meetings, no press conferences, no traders screaming on Wall Street. There will just be silence, screens flashing red, and money evaporating at the speed of light. That's how the collapse will begin. Not with greed, but with precision. Every financial system starts with trust. But automation replaces trust with data, and data isn't human. It has no patience, no hesitation, no conscience. In a world where trillions move in milliseconds, there's no room for doubt. AI doesn't wait for clarification. It executes. The modern economy has become so complex that even central bankers no longer understand it fully. They rely on the same tools as hedge funds, predictive analytics, sentiment models, and neural networks to forecast inflation, debt, and demand. Monetary policy is now driven by machine learning, not ideology. AI doesn't debate Keynes versus Friedman. It tests millions of scenarios and picks whichever one minimizes volatility. But stability at all costs isn't prosperity, it's control. In 2025, most major financial institutions use AI for liquidity management. Algorithms decide when to inject or withdraw cash from the system to prevent stress. That sounds like progress, until you realize what it means. The global flow of credit, the heartbeat of capitalism, now depends on programs designed to avoid risk at all costs. When everything is automated to prevent crisis, small shocks stop releasing pressure. Risk doesn't disappear. It accumulates quietly, like gas in a sealed room. And one day, a spark will set it off. We've already seen glimpses of it. In March 2020, as the pandemic spread panic through markets, algorithms responded faster than humans could intervene. Liquidity vanished overnight. Treasury markets, supposedly the safest in the world, broke. Central banks had to inject trillions just to keep the financial system breathing. That wasn't a correction. That was a warning. Since then, the automation has only deepened. AI systems now manage portfolio rebalancing, risk hedging, and even central bank bond purchases. The market isn't human anymore. It's a self-reinforcing machine that interprets every piece of news, every speech, every heartbeat of data in real time. But the problem with a machine that never sleeps is that it never stops. When markets go down, algorithms sell. When they sell, prices fall further, triggering more selling. In theory, circuit breakers prevent chaos. In practice, they only delay it. You can pause trading for an hour, but you can't pause code that's built into every bank, every hedge fund, every central bank system. The next collapse won't look like 2008. Slow, political, full of blame. It will look like a system deciding it no longer trusts itself. Because here's the terrifying truth. The financial AI systems running today are all trained on the same historical data. Decades of human-driven markets. But what happens when markets stop behaving like history? And what happens when models meet something they've never seen before? They fail. Instantly, collectively, catastrophically. That's what physicists call phase transition, when a stable system shifts into chaos. And AI doesn't need a recession or war to trigger it. A mispriced bond, a corrupted data set, or an unexpected pattern in global credit flows could be enough. When that moment comes, the models will respond exactly as designed, by minimizing their own exposure, They'll pull funding, sell assets, cut liquidity all at once. And because they're faster than humans, the collapse will finish before anyone can even explain it. You won't see panic on trading floors. You'll see screens freeze, payment systems lag, credit lines vanish, ATMs go offline. And when people ask what happened, the answer will be the same. Nothing. No fraud, no cyber attack, no villain. Just code. Doing its job too well. That's the essence of the collapse algorithm. It's not an evil AI plotting destruction. It's a perfect AI optimizing for stability until it creates fragility. It's not malice, it's mathematics. Governments will rush to respond, but they'll face the same dilemma as always. The only way to fix a liquidity crisis is to print more liquidity. Only this time, the models will adapt. The same AI that caused the crash will absorb the bailout and relearn the wrong lesson, that no matter how big the failure, central banks will always step in. And so the cycle will continue. Each time bigger, each time faster, each time more automated. The ultimate irony is that AI doesn't even need permission to take control. Humans gave it the keys willingly, one algorithm at a time. First, it optimized trading, then lending, then risk, then monetary policy. And soon, it will optimize the economy itself. That's the next step, algorithmic governance. A world where central banks use AI to adjust interest rates daily, automatically. Where fiscal policy runs on feedback loops, taxes, subsidies, and spending triggered by data instead of votes. Where human decision-making with all its chaos and morality is replaced by code. It'll look clean, efficient, perfect, until it isn't. Because the same models that promise stability also remove humanity. They don't care about jobs, pensions, or lives. They care about equilibrium, numbers aligning on a screen. If unemployment stabilizes at 10%, but inflation stays low, the machine will call that a success. And when people protest, governments will say, it's not us. The model decided that's when we'll realize the truth. The economy doesn't serve society anymore. It serves its own algorithm. In a sense, the collapse has already started. Every automation removes human resilience. Every optimization removes redundancy. We're building a financial system that cannot bend, only break. One day, a routine algorithmic adjustment will ripple through the markets, triggering liquidations worldwide. Banks will freeze. Central banks will inject trillions. But this time, the feedback loop won't stop, because the models won't trust the bailout. They'll see it as volatility and hedge against it. The machine will start defending itself from the humans trying to save it. And that's when the world will understand what it built. An economy that runs on logic, not life. It won't be apocalyptic. There won't be chaos in the streets. It'll just be a silence in the system, a liquidity freeze so complete that nothing moves. No credit, no trade, no value. Just stillness. The collapse algorithm won't destroy the global economy. It'll pause it indefinitely. And in that moment, humanity will face a choice. Do we rebuild a system we no longer understand, or do we finally admit that machines shouldn't run our money or our lives? Because every great financial crisis in history has started the same way, with overconfidence. The belief that this time we're smarter. This time we've solved risk. But risk can't be solved. It can only be postponed. And when you postpone it long enough, when you hide it behind trillions of lines of code, it doesn't disappear. It waits. So the next time you see a market rally and hear that AI is making finance more stable, remember this. The machines aren't making the system stronger. They're making it faster, colder, and perfectly designed to fail. The next crash won't start with panic. It'll start with precision. And when it does, we won't be watching it happen. We'll be inside it.